Sometime in the last year or two, CNBC figured out my secret to success as a finance channel on YouTube: putting The Big Short in the title. And so now we get a Steve Eisman interview on a monthly basis, each time with Eisman dressing a little better and looking a little happier.
Looking sharp today, too.
Looking sharp.
I mean, really, look at this. Just take a second.
True.
All right, let's just compliment my wife.
The face of a man whose funds assets just went up by millions. But anyway, back on CNBC and Bloomberg last week, Eisman spoke about the economy, the housing market, fiscal policy, and most interestingly, his bet for the artificial intelligence boom. No, not Nvidia or Microsoft. In fact, it's probably a stock you wouldn't think to associate with AI. But first, let's hear Eisman's view on the economy. And unlike some of the perma-bears on CNBC, he actually thinks it's in pretty good shape right now.
So many people were trying to make that same call over the last year and a half. And it's on some level, it's actually even more impressive that you've kind of been in the other way. Because I think the inclination for many investors was this is just a time bomb waiting to blow up. So
there's no time bomb. I mean, on the credit side, credit quality is fine. Credit card delinquencies are starting to come down. Charge-offs are kind of sticky, but they're at low levels. In terms of the health of the consumer, the upper-end consumer is in great shape. The lower-end consumer is having trouble with inflation, and it's showing up in their spending. And the middle consumer is kind of treading water. It's kind of the way it's been for a very, very long time. So I just don't see the consumer as impact. I mean, it impacts obviously certain subsectors, but it is not an issue for the overall economy.
One way many investors and economists assess the health of the consumer is by looking at the delinquency rates on credit cards, which makes a whole lot of sense because if there's a lot of people missing their credit card payments, then it's a pretty clear indication of high financial stress. Eisman says delinquencies have been falling, which are accounts with payments late by more than 30 days. And maybe I'm missing some very, very recent data, but it's not exactly what I see. A report from the Federal Bank of St. Louis in mid-May found the percentage of credit card debt that is delinquent has been rising sharply since mid-2022, reaching the highest level since the global financial crisis. And unsurprisingly, the poorest 10% of zip codes have the highest rate, hitting 21%. With prices at a level much higher than even just a couple of years ago, people are also saving a much smaller percentage of their income than normal. The Bureau of Economic Analysis found the personal savings rate was 3.6% in April, well below the 8% average going back to 1959. The positive note is that despite delinquencies rising and the very low savings rate, consumers are continuing to spend. American Express, Visa, and MasterCard have broadly described spending trends as relatively strong, driven by consumer spending on travel and experiences over other types of discretionary purchases. A Morgan Stanley survey found that 60% of US consumers are planning to travel this summer.
How do you feel? I'm curious. How do you feel about the housing trade? If you are a believer that the economy is in good shape, the consumer is in pretty good shape.
I mean, the problem with the housing market is, people are stuck in their homes because they have 3% mortgages and they have jobs. So somebody's going to get a 7.5% mortgage to have the same monthly payment as the person with a 3% mortgage. The housing price has to get cut in half. Mm-hmm. Now, is somebody with a job going to sell their house and cut in half? No.
Annual existing home sales in the US was recently recorded at 4.1 million, which historically speaking is very low. And sales have fallen in a meaningful way since 2022 when interest rates on mortgages began to rise. Because just 3 years ago, the average 30-year fixed mortgage was under 3%. Today, it's 7%. But what it means is there are tons of Americans who got into mortgages at 3% just a couple of years ago, or refinanced at 3% just a couple of years ago, and have absolutely no interest on letting that go. A Goldman Sachs analysis found that 28% of borrowers have a mortgage rate below 3%, and 72% are still at a rate below 4%. The implication, of course, being that people don't want to trade their home that they currently have with a 3% mortgage for a new home with a 7% mortgage. I mean, they might even be downgrading just to pay the same amount or even more on their monthly mortgage payment. So a household in one of these very low rate mortgages would probably only be willing to sell out of necessity, such as upgrading to support a larger family or downsizing due to a loss of income. And speaking of debt, on Bloomberg, Eisman spoke about the government's deficit problem.
So spending will continue.
Yes.
Tax cuts will get extended. Yes.
Tariffs on the margin will be there.
Yep.
This, to me, raises questions that a lot of people have talked about, which is the deficit not going away at the time where you're going to have to see some of the issuance numbers really start to pick up. You seem to discount that too. You don't think that necessarily...
100%.
Okay,
it's not an issue.
Okay, so you don't think the deficit's an issue?
It's not an issue. Can I tell you why? Look, I'm not an economist. I can only say this, that the people who have been complaining about the deficit, and I like to call them the deficit people, okay?
Because that's what it sounds like.
Because that's what they sound like. have been literally been saying, the deficit for 40 years.
Eisman very clearly isn't concerned about the deficit, and it's not because he thinks it will be turned around soon. He thinks that the government, regardless of who is elected in November, will continue to spend in a meaningful way, and that the tax cuts implemented during the Trump administration are likely to stay in place, which would suggest that the $1.7 trillion 2023 deficit might expand over the coming years, bringing the US closer to a 25-year period of the government using debt to fund spending that exceeds their revenue. The economists out there who are concerned about the government's deficit are essentially concerned that they'll enter some kind of debt spiral. The $35 trillion national debt is increasing at an astounding rate, and largely this is due to the fact that the government continues to spend more money than they collect in revenue, but it's also due to the fact that interest rates have recently risen a lot. The US recently passed $1 trillion in annual interest payments on their debt, or 13% of total spending so far in the financial year 2024. Just the fact of having a large amount of debt means that spending is higher because of those interest payments, and that means that the deficit is worse, which means that the government every year needs to borrow a larger amount of money, and borrowing more money means those interest payments and government spending also goes up. A death spiral that some economists are concerned about. But Eisman's point is also very true, which is the people, the economists, investors who have been talking about the US government deficit and the debt crisis, a lot of them have been talking about this for decades. And that demonstrates a really important element of economics. Obviously, anyone with a brain can understand that if you're running a constant deficit and increasing your debt, there is a point at which that doesn't work anymore. It's either going to be that the government needs to take on so much debt annually that they can't sell enough, they literally can't sell enough bonds in order to cover those obligations, or it'll be the Fed that steps in, prints money, and is the one buying those bonds, essentially lending the money to the government, and the currency would devalue. But the point is, nobody knows where the breaking point is, where the inflection point is. And so trying to predict when this is an issue or if it'll be an issue is something that's fairly pointless. The interest rate on a 10-year US bond is set by supply and demand. The demand comes from people wanting to store their money in government bonds to earn a small yield, and the supply comes from investors wanting to sell those bonds to invest elsewhere, but also, importantly, from the government creating new bonds when they need to borrow additional money. The government will have a real problem if there are not enough buyers of their bonds, but we will see this happening because long interest rates on government bonds will start to go up. But let's now pivot to artificial intelligence, which inarguably has been the biggest driver of the stock market over the past year, particularly led by Nvidia, which is up 140% year to date.
That's obviously not the hidden one. It is the most obvious one. But is that one that you still feel comfortable holding?
I mean, look, right now, the easiest way to play AI is Nvidia, AMD, a few other chip players, and then anybody who is in the cloud or with a massive database.
The biggest winners of the AI revolution thus far have been those supplying the hardware infrastructure needed for building large language models like ChatGPT, which at the moment is primarily Nvidia. They reported $22.6 billion in data center sales last quarter, 427% higher than a year ago. And it's because they make the most powerful GPUs on the market, including the H100 chip designed specifically for AI applications. Companies like Meta have been buying tens of thousands of these to build their generative AI models, and they're not exactly cheap. And so in the space of just a couple of months, Nvidia now has many companies spending hundreds of millions of dollars, if not more, on these chips. But Eisman sees another way to catch the AI wave.
You know, right now everybody's focused on Nvidia and AMD and data centers, but one day, and that day is not too far from now, there'll be a lot of AI apps you and I will use. And we're not going to use them at a data center in the cloud. We're going to want to use them on our phone because we want it at the head end, right here. So at that point, there's going to be, I think, an entire new sales cycle of phones, laptops that are going to need to be upgraded to be able to do all this stuff that eventually we will want to do. That's Apple.
While it's been chip makers benefiting from AI thus far, down the road, Eisman sees consumer hardware companies like Apple benefiting from a complete recycle of products. AI models take an enormous amount of compute power to operate, and so if they're going to be running locally on your mobile device or on your computer, then there's probably going to have to be a significant hardware upgrade at some point down the line. At the moment, companies like Google get around this by having different versions of an AI model. High-powered versions that use Google's data centers to do the processing over the cloud, and less capable models that do the processing locally on your phone for the fastest response time. If you're doing something on your phone with AI, then you probably need the processing time to be extremely fast. So ideally, you'd want the model to be running locally on your device. But those models aren't very powerful, and so there'll likely be many apps that need a much more capable device.
So you're buying Apple aggressively?
Well, we've owned it for a long time, and we continue to own it. Now, but it's not actionable at this second because that hasn't been an app. What app? I don't know. When it shows up, I'll let you know.
To play devil's advocate, while we certainly have little visibility on how AI will change our lives in the coming years, we also have very little visibility about how cloud services will change. Today, in 2024, having an AI model process locally is much faster than, say, Microsoft doing the processing and then just displaying the results via the internet. But it's also entirely possible that internet bandwidth speeds improve in a massive way over the next decade or two and make local hardware, essentially obsolete. Movies used to be on VCR tapes, then DVDs, and then Blu-rays, each upgrade requiring new hardware to watch movies. And yet today, in your house, you might not even have a way to play physical discs. Yes, your TV needs a bit of compute power, but because internet speeds got fast enough, your TV can just stream the movie straight from Netflix's servers. Well, which is technically Amazon's data centers. But the point being, if internet speeds can get fast enough, why wouldn't that also be the case for streaming video games, for example, that require currently a console in your house? Why couldn't that be streamed from the cloud? And then also AI algorithms. And I think the point is, I'm not trying to say that's going to happen, but when we're talking about new technologies, particularly investing in new technologies, just be careful because what we think the future will look like is probably not what it's going to look like. Subscribe for free if you enjoyed the video and check out some of these videos next.